Hey traders, this is Scott. This is a tutorial on how to use a scout and scale in on your trades, okay? So, in a cavalry situation, cavalry always sends a scout out before they send all the men into battle, all right? So that's why we call it a scout, because we're going to take a very small position, we're going to put it in battle, and then we're going to see if we can't join it, all right? So, if the stop is to protect your margin, it's not here to protect this trade. You use the parameters of the trade, but it's not here for that. It's here to protect your margin. You can start with a scout with a bigger stop, all right? So as your trade proves itself, you add to it with ever tighter stops, all right? Once in profit, you can repeat the process since essentially your margin is back to you. However, be aware that you need to be watching your margin account so you don't get a margin call, all right? So, in other words, your stop is based on the amount of money you're willing to risk versus a technical stop based on support and resistance. However, you do need to know where the technical stop is, all right? So, always divide your position into three parts, and that can never equal more than 2%, all right? So an example we're going to give you, let's say that we could risk $90 today, all right? So we could put 3 minis on with a 30 pip stop, and we've risked $90. Or we could put a 1 mini on with a 90 pip stop, we have $100 at risk, or $90 at risk, okay? And so let's see how that would work, all right? So here we are, we're getting ready to trade. We divided our chart, our trade position into 3 positions, all right? So we can see that we got a break hook and go of the pole right there, okay? So our first trade goes on right there, but this time the stop is 90 pips. Now what that does for us is we're not gonna get wicked in on a little retracement that pulls up there, hits us by 2 pips, and then knocks us out of the trade, all right? So we'll be able to live through any pullback at that point in time, all right? Now people say, 90 pips, oh, what if it goes all the way back? You would never let it go back all the way back, all right? When you realize, okay, it's not going to do it, it goes back up into the pole, you realize this trade isn't going to work right now, and you exit immediately, all right? So in this case, you might have a 12 pips loss or a 15 pip stop loss, that kind of thing, all right? All right, so then as you see it breaking the bottom down here, you add a second position. Okay, now, your normal stop has to be divided in 2 because you can't have more than $90 at risk. All right, so in this case, you would have to adjust your stops to 45 pips. All right, But the good news is you now have 2 positions on. Usually, by the time you get the 3rd position on, trades 1 and 2 are in profit, and trade 3 goes on with a normal stop. All right, and you see it would have been really fine in that area. All right, then of course over here, well, let's go do it again. All right, so how much are you willing to risk to see if you are right? That's essentially what we're doing. We're willing to risk a scout to see if we're right. And if we're right, then we're willing to add to that position, all right? So that's what you need to be thinking like, all right? So in order to use a scout, that means we only have 1/3 of our position on. That means that we have to press our winners without exception. We will not make any money if we only trade with 1/3 of our lots. So we always have to find a way to get the other trades in play, all right? So as you can see, this is an illustration using a cue ball and pool, all right? Well, you can see that this guy's going to knock this ball into the corner pocket. But before he hits this ball in the corner pocket, he has to think about the shot from ball 2 and the shot from ball 3. So he has to hit this ball right here with enough speed and at the right trajectory that it goes over here, it bounces, and bounces and comes back, so he gets trade 2. Now before he can make trade 2, he's got to figure out how to hit this ball so it goes in the corner pocket and either stops dead so he can hit this one or move a little bit and then he can take it down to the corner pocket. So you see, he has to make all 3 of these decisions before he ever hits this 9 ball into the pocket. And that's the same as trading. It's called pressing your winners, all right? We look for areas, wide open spaces, where we have the ability to press our winners. We enter the water with a scout, the wide open space with a scout. As the trade begins to prove ourselves, we keep adding to that position with ever tighter stops, okay? So the most dangerous time to put a trade on is the very first trade, all right? Because you don't know if it's going to go. Once it's starting to prove it's going to go, well, if you didn't put it in, now you're late, all right? We've all done that, all right? So scaling in forces you to press your winners, and using a scout forces you to press your winners. Now, if you can't find trade 2 and maybe trade 3, then you should rethink trade 1, Because if you don't have enough space to put 2 and 3 in, neither does a big boy, and they're the people who drive that market up there. So if you don't have any room, does a big boy? If not, pass on that trade, all right? Now, you cannot be successful if you do not press your winners, okay? All right, unless you press your winners, one win only offsets one loss, okay? But if you're making, every time you make a loss, you're only doing that with one lot at 1/3 of your lots. But every time you make a win, you're making a win with 2 and 3 and 4 and 5. You can see that you will exponentially increase your margin account, and you will cut your winners quickly, and there will be small losses, all right? So using a scout is scaling in, and then trade management as the trade matures. Remember, a scout is 1/3 position with 3 times the technical stop. Now that requires that you add the other 2 somewhere in the expected route. So you must have a wide open space. If you can't find trade 2 or 3, rethink the trade. All right. So here's an example that we traded this week. All right. So you can see you have a pole right here, okay? Now, you got a break hook and go, all right? That'd be your first trade right there. See that? Second trade is this wide open space right there. So the first trade would go on with, let's say, a 100 pip stop, all right? As soon as you put the second trade on, okay, now you move both of those stops to 50 pips. You have no more money at risk, okay? You see the pullback here and the break through this area into the wide open space here. You can place your fourth trade in the top half of this. Now you would use this top right here as a support and resistance. These first 2 trades were well in profit, see? So you just used the regular technical stop for the third trade, and you can see you could have even got a 4th trade on in the break of the fibs down here, all right? So there's an example of how to do it, all right? Now, you always need to recognize why you made the trade in the first place. So I've got an example here. The trade reasons were I was in a downtrend, I was in a down channel, and I had a 50% pullback right here, okay? Now, with a 50% pullback right here, I make the trade, and immediately pulls back up, and right here, as soon as it exits this channel right here, the trade is no longer valid. Why? The reason I made the trade, because I was in a channel, all right? I'm no longer in the channel. Exit the trade. But your stop is 90 pips up here. That's okay. That's why I'm gonna click it out right here with about, if I entered here, maybe it's a 12 or 15 pip loss. So you see my loss becomes little, right? Now, you can see that that was the right decision. That's the same trade. It never, ever, ever came back. And what happens to traders is they say, oh, it'll come back, I'll live with it. And the next thing you know, they're upside down, 200, 300 pips, and the market isn't coming back. In fact, it's trending the other way. So that's why you have to execute based this way, all right? So hope that helps you, all right? So, and remember, in trade management, you must always remember why you made the trade. Since that no longer exists, you must bail on the trade. That means you major in risk, not the reward. You enter the trade based on risk and reward, and when the trade starts your way, you are now majoring in risk, no longer in reward. You identified the reward before you ever made the trade. The question then be, can I add the cue ball, and should I move my stop? Every time you add the second or third trade, you move your stop, all right? So keep it simple and successful. Don't be like this girl doing a counter trend B wave with a Gartley and who needs a break hook and go. If you do that, you're gonna smash into the concrete. Okay, I hope that helps you. Talk to you soon.